Ashish Agrawal, Director, Resurgent India. Last but not least, Ananya Sonthalia, Partner Trilegal, who's going to be moderating this panel for us. We'll introduce Ananya. Ananya is part of the asset management practice at Trilegal. Her areas of practice include investment funds and asset management, private client advisory, venture capital, private credit, and financial services regulation. She regularly advises clients in relation to fund formation and fund structuring, joint ventures, entry strategy, and corporate restructurings. She also advises clients on aspects of financial services regulations pertaining to securities market and exchange control. Key clients Ananya has worked with include multilateral financial institutions, private equity funds, private credit funds, and insurance companies. Over to you, Ananya. Thank you.
Thank you for the introduction. Good afternoon, everyone. Should we just wait for some more people to come in? Yeah, and then. Hi. So I think we'll start with just an introduction from the panel and then moving on to how each of you define growth capital investment strategy. Whether it has to do with profitability, whether it has to do with governance maturity, or is it something else entirely?
Yeah. So, good morning, everybody. I'm Ashish Agrawal. I'm Director in Resurgent India Limited. Resurgent India Limited is a registered merchant bank, and we practice both fee-based and fund-based services actually. So, we work majorly on the mid-stage companies, both in the debt and equity. We have two AIFs where we invest in the different class of assets, which is stressed assets and the pre-IPO. So regarding this growth capital investment and all India's ecosystem, from investment banker perspective, I see uh, there are many things which have been added in last decade. Actually, in one decade, if you see, the many things have been improved actually in terms of the fund ecosystem, government regulations, and all these things. And but there are many things which are to be yet to be done from the mid market or the growth capital point of view. If I give you the some statistics, as per the MCA data, there are 26 lakhs companies are registered in India. Out of that, 40,000 companies are there, which are ranging from 100 crore to 5,000 crore of top line. So this is the market for the growth capital, because if you see from the startup ecosystem, also up to 100 crore is a part of startup ecosystem, and then the mid market and growth capital companies are 40,000 companies are there as per the data of the MCA. And if I see the IPO and the funded company will not be more than 1,000, will be less than 1,000. So market is huge actually. But what are the challenges and why the ecosystem is not so strong? I'll just highlight on three, four things actually. The one is that the gap, the missing middle kind of gap actually there. Actually, a lot of venture capital VC funds are there, which are into early stage. Then the late stage and the IPO stage funds are there also. But in the missing space, I discussed with some of the co-panelists also. They are into the space in the missing middle also. But still, the companies which are into 100 to 1,000 crore turnover, they are facing challenges actually in terms of, because they are near to profitable or they are profitable actually. So for them, what are the challenges which I just to highlight actually? One is that the governance gap is there, which we are seeing actually, because these companies have grown suddenly and they don't have that much of the professional team, which is very, very important from the fund point of view. The board, which is not as per the requirement, which should be from the equity fund of view. RPT transaction, this is one of the area I think all will agree on that. Actually, there are a lot of related party transactions are there. So this is one of the area where the companies are not in a position. Out of this 40,000 company, only maybe max 1,000 company could get the funds from the market or the IPO. Even 39 1,000 companies are struggling. So that's one area which need to be taken care of. Many founders are there here actually. So they should see this part actually before reaching to any investor. That's the one area actually. Then the valuation mismatch. It is always, I think this is not to be discussed because this is always there. But the company which have grown suddenly, they are always asking the valuation of 2021, and the investors are always looking the valuation of the current market and also how to bridge the gap of these valuations. So many of the funds are now having the strategy where they want to give the milestone kind of valuations so that they can be the win-win for both the sides actually. Then another aspect which is the ecosystem growth capital, from the venture capital to the senior debt, banking debt, where you see that a lot of companies which are in the startup space, they got the venture debt actually, but practically they are not getting the senior debt. So this is also, I think, giving some kind of struggle to them to get the part of the main ecosystem in the debt ecosystem actually. So their borrowing cost is very high. How to reduce it? Because it cannot be, the business cannot rely 100% on the equity. There should be a mix of debt and equity actually. So if you see, government of India has come out the scheme which is mainly for the startups which are up to 100 crore. But for the missing middle, there is no scheme such the ecosystem where they can get the funding which are company which are not profit making and all these things actually. So this is one area which need to be improved actually. And lastly, if I see the foreign capital, still the domestic capital is a challenge. We have raised, I think, got the commitment of $16 billion AIF, but still you see that majority of the money has come from the outside. The domestic capital also, in the first panel we were discussing with the other panelists also, they have said that the large capital provider of the country, like pension fund or insurance and the bank, still they have a limitation from the regulation itself or from the mindset itself actually. So if this pool can be the part of the ecosystem, then definitely this will help to get the lot of money, the long-term money, patient capital actually, because you see that this is important. We are getting money, but we are not getting the so much of money which are required from the ecosystem point of view. So these are some of the thoughts which I have in my mind.
Hi, good afternoon, everyone. There are, just for everybody's benefit, there are two Sumits on the panel today. So I'm just going to clarify that I'm Sumit Jain. I work for 361 Asset, which is a multi-stage private equity and venture capital platform. Within that, I'm responsible for the venture growth investments, which is usually Series A, B, C, D deals. And we'll get into more questions as Ananya takes the conversation forward.
Thank you for introducing me, Sumit. But I'm Sumit Sinha, partner at Filter Capital. It's a growth equity firm focused on tech-led companies in India. We define our sandbox in a unique way because if you look at growth capital, it has high risk, high reward growth capital all the way to lower risk, lower reward growth capital. We play more on the latter end, more private equity like investing than venture growth, as Sumit rightly put in. And growth capital comes in all types of flavor, but we are more private equity than venture.
Normally, I'm the one with a name like Srinivas. I have a problem of too many Srinivases. So today, I'm happy that there are two Sumits and only one Srinivas. So I'm Srinivas Baratam, and I represent a fund called Stakeboat Capital. We are a private equity fund. We say that we categorize the market and we say that we invest at the low end of the mid market, which is very similar to the kind of category that Ashish was referring to. So the revenue category that we have is maybe from about 80-90 crores at the lower end to about maybe 1,000 crores at the higher end. That's the spot that we play in. In terms of sectors, healthcare, life sciences, industrials, B2B tech, and B2B services. So that's our play. And Deepak.
Hi, I'm Deepak. I'm with Ascent Capital. Ascent Capital is a growth equity fund. We invest across sectors in companies that are profitable, not profitable. I'll come to the definition in a minute. But over a period of, since we've been in business since 2008, currently investing out of the third fund, and obviously have built a fairly good portfolio of companies over a period of time. Mid-market for us is essentially companies that have already found a product market fit and are coming to us for growth capital. By that, we mean that it is essentially money is not getting spent to establish a product market fit, but more towards either opening up marketing channels or go to market, expanding the team, making sure that whatever traction they're seeing in the early days, capital is not a constraint for them to grow. And across the sectors, I mean, I think one of the questions was whether it is profitable, not profitable. If you look at it, the way we look at it is a little different. We are a little, in each of the buckets of sectors that we operate in, it's a little different. So, for example, healthcare, typically these are companies for hospitals, for example, are mostly promoter run. First institutional investment is still pending. So they're looking for a partner who has done they know the business very well, but they don't know the governance and the shareholding and the mostly it's going to be profitable companies. Technology, obviously, it is Series B plus. We cannot expect Indian companies to be profitable at that stage, but hopefully they would have found a product market fit. They would be demonstrating positive margins, but EBITDA is still negative. That's okay with us. Financial services obviously is more of a I would say it is a late stage game rather than an early stage game. So mostly closer to an IPO is where we look at. And then finally, consumer, again, as you see, I mean, there are a lot of companies that are getting formed. So brands is something that we are definitely interested in. In most cases, these are still a bit negative. But I think more and more we see it. I think it is better to see the unit economics rather than profitability by itself.
Thanks, Deepak. We'll stay with you. You've been investing in India's mid-market companies for the last, 15 plus years, and you've seen it through the ZIRP era, through the 2021 funding boom, the correction, and now. How do the last couple of years compare to the current environment, and where the frothy IPO markets and valuations were making growth stage deals particularly hard to price?
Yeah, I think I would put two lenses on it. I don't want to make it too elaborate, but two lenses. One is the AI lens. The other one is the IPO lens. If you look at the IPO lens, I mean, you're right. Over the last couple of years, I think IPOs were really hot in the market. And I mean, people who wanted to do a strategic, I mean, we have also changed and said that IPO is the first mode of exit. But we know that over a period of time, the windows in India are very short. And whether that window is going to stay, we don't know. But there are some structural changes like the SIP money coming in and things like that, which maybe we can argue that IPOs will continue to happen. But if you look at it from that lens, the reason deal flow is good for mid-market firms like us is because a lot of the mid-market firms moved a little bit ahead because obviously it is LPs are our customers. They want DPI yesterday, not 3 years, 4 years down the line. So some of the firms obviously moved towards creating early DPI because, obviously there was a lot of traction in the IPO market. But that left the firms that were 4 years, 5 years away from an IPO a little bit orphaned. And that's why valuations have been good and deal flow has been pretty reasonable as well. That is mostly because of the IPO boom, and we should thank that for that. And the second part of it is the AI lens. Obviously, a lot of investors, especially in India, I still believe that we are probably maybe 3-4 years behind US, maybe China. We don't know what's going to happen in India, especially with the services companies. So the way to look at it is any company that is coming in, and I think the one question that we all ask is whether this is going to get disrupted by AI, right? So that is why I think a lot of traction is happening in the physical part of the economy, like the manufacturing sector. If you look at it, defense was hot for a long, long time. But anything that is pure software, I think, is a little bit difficult right now. And a lot of the Indian companies are like that. So I think those are the two things that I would leave you with.
Thanks for that. I'll actually come to the AI piece in a bit. But before that, I want to ask the question to Sumit Sinha from Filter Capital. Sumit, Filter Capital was actually one of the few firms which was built on the missing middle piece, right? That was your thesis. So, and you have really helped break out tech companies and, put capillary, particularly on the IPO scene. So what does a complete growth investment strategy or policy in your mind look like? Like, how do you evaluate and see where the company is going to go and how it should mature?
Yeah, capillary was actually a big learning experience, not just for us, but for the whole industry. It was a poster child of, is the mic working? Sorry. It was a poster child of enterprise SaaS set up in 2008. All the big venture firms piled in. I was at Warburg Pincus when we led their Series C, and they had to do a massive retooling after COVID because they realized that A, they were operating in a small market, B, they were doing too many things, and C, they were only focused on retail, which was shut during COVID. So I think one of the things that we learned from that experience, which has helped us also fine tune our strategy, is A, it's very important to focus. And once they had that experience, they actually doubled down on just their loyalty product. They shut down all other products. They had e-commerce enablement. They had campaigns and whatnot. And second is once you have fine-tuned your strategy, when you have focus, then you have to really go broad in terms of segments or sectors that you address. So instead of just retail, they went to hospitality and healthcare. And then they entered the US market, and one acquisition later, they opened up a massive market. And the business was $20 million when we had invested in 2021. It's today $80 million and with 15-20% EBITDA margin. So I think for us, a big part of what we do when we enter is to drive focus in strategy. Often we find that companies are throwing spaghetti on the wall, and we have to help them fine tune what they should be doing and what they should not be doing. And that is an important part of my evaluation. We like founders who narrow down, and we don't necessarily gel with founders who want to experiment too much at the stage we come in. That does exclude us from a lot of opportunities in the market, which will require venture style investing even at growth stages, and we are fine letting them go. For example, opportunities in quick commerce or deep tech, some of those, I think it's fine. That's not for us. We're trying to build sustainable businesses that we can eventually list.
Actually, coming on that, you mentioned that when you invested in Capillary, it was into enterprise SaaS and everything. At present day, when AI sort of has become the buzzword, do you think enterprise SaaS is dead? Or do you think that there is still like a lot of value proposition in companies which are pursuing enterprise SaaS?
Yeah, I think enterprise SaaS will be different going forward. I think 2-3 things will happen. One, the platforms that are already embedded in large enterprises, I think they have a huge opportunity to create that AI layer, the intelligence layer, the agentic layer, as they say, and give more value to the customers. And Capillary is doing that. I think quarter of their customers are using the AI tool. One customer is paying them $1 million a year just for the AI tool that they bought. And we've seen the SaaScopolis, or whatever it's called, come in and out, and we've already seen how ServiceNow and Workday and SAP are doing really well. So we feel the existing software companies who are deeply embedded will do better, and we are bullish about that. When it comes to startups in AI software, we are not sure what the business model will be. I'm actually a bigger believer in AI services than AI software, because I meet a lot of venture capital funds and say, okay, I have this AI software, I have that AI software, and they're kind of doing a few things here and there, but the customer is asking for a solution. They're not asking for a workflow anymore. And if you can combine that software capability with a solution which involves some level of services, that, in my view, is the future of AI software or services, or whatever you call it. I think the lines are blurring. So yeah, enterprise software in the next era will be a little bit more services led than before.
So next question is to Srini. You've obviously seen buy side and advisory environments through so many years. When a growth stage company is being diligenced, what do you think are the key indicators, and what really turns out to be a real problem 6 months down the line, which probably investors just ignore at the beginning and they feel it can be getting resolved, and then it just, becomes a problem and keeps getting bigger?
Billion-dollar question, right? So to be, okay, let me just categorize it in terms of the segment that we normally invest into. So we don't invest into startups. What we do is invest into companies which already have about 100 crores of revenue. And more often than not, we nowadays find that the revenues are in the 200 to 300 crore kind of range. And these companies would have existed for at least 20, 25 years. The founders that we have been backing have typically been in their 40s and 50s and not in their 20s and 30s. There's an outcome. There's not a template issue for us, but that's the outcome. Now, from that point of view, we are looking at companies which have existed for a while. And by and large, we are the first institutional investor investing into these businesses. So these companies have never had institutional investors. So when we get into these kind of situations, there are a lot of things to be sorted out, right? There are a lot of diligence issues. Now, if I were to split the diligence issues into two categories again, one is ability, the other one is intent. Now, from an ability point of view, we are talking about whether they're in the right sector, they have the right numbers, the right business model, and these things like that. Most of that can be done through desk research or through remote calls or whatever it is, right? But when we actually go to the visit a company, there's a lot of focus on intent in terms of, what is it that they've been doing. Simple things like, the hygiene in the washrooms, right? These kind of things, gone off. Oh no, it's back. So these kind of things actually show the intent, right? So what are the kind of things they've slipped up on? Have they slipped up on things that they could have actually done? Or is it because, they probably did not have couldn't do it? Can we potentially help them? So we call them fixable flaws internally. If these are fixable flaws, we don't mind getting into a situation as long as the ability is there. But if these are things that can't be fixed, then one should back away. Now, most of us, collectively, the three investing partners at our firm, we have more than 80 years of investing experience, have invested in more than 100 businesses in our lives. So there's a little bit of experience that we've gained. And, I may even want to call it wisdom. While, wisdom is a very maligned word, let me just use the word wisdom. So, we have that. So all of that needs to be put to use. So at the point at which we are doing a diligence, we want to avoid those pitfalls. We want to avoid this 6 month, 1 year, whatever it is, the issue. Having said, do we have those issues? Of course, we do, because, things just come from nowhere, including Mr. Trump and his tariffs. I read this morning again, he's talking about tariffs for forced labor. Now, weren't the railroads in the US built through forced labor? And they had slavery till the 1960s. What are they talking about forced labor? I mean, this is what happens, right? The Gulf War, when it started, the recent Gulf War, it was a huge issue because, we had companies who were manufacturing and they needed to ship. They were exporting. The transportation costs just went through the roof. And customers are not going to pay for that kind of a transportation cost. And we can't possibly absorb that. So these kind of things come. Now, these are things that we have to, work through, do the stuff. But there are things that you can never do anything about. Let me just give you an example. This is from more than 30 years ago. One of my first credit assignments that I was working on. It was in one of the small towns. Don't want to name the town, but small towns. So we had to take a train from Hyderabad and get there. So we go there and all work done. We wanted to take the return train back in the evening. The founder's, finance manager, he insisted that we have to go to the founder's house for dinner. We said, no, we're not. We're going to the station. He said, sure. He comes and picks us up. And he said he was driving us to the station, but he actually took us to the founder's house. Now, in the founder's house, we enter. It was a nice palatial place, okay? And it had brilliant marble, the kind of marble that I probably had not seen in a house before that. So I just made an innocuous comment that, oh, brilliant marble, I really like this marble. You know what he answered? He said, sir, this was built before the IPO. Now, when you hear something like that, what is the instantaneous conclusion? Now, my conclusion could be different from somebody else's conclusion. But it's pretty clear to all of us in terms of, why he made such a defensive statement. Now, that is a company that I would never invest into because he made a comment. So these are the kind of things that one would look for when one is diligencing, and that is what drives investment decision. It is not the ability piece that drives, it is these subjective pieces which drives an investment decision, because ultimately, once we give money, even if we have control, we are a control investor, we have an operator operating, right? We normally do not get into a situation where we go and change the management team. We typically get into a situation where we're backing the founder, even if when we have a control, and therefore we need to depend on the control. Day in, day out, it's the manager running it, right? So what are we doing? We're probably going in there once or twice a week or once or twice a month, whatever it is. And there is only so much we can do and so much we can see. So beyond that, the investment is, or the outcome of the investment is driven by these kind of subjective things. So we're very, very mindful of that. In a fund life, we want to make 10, 12 investments. It's better to avoid that. Maybe I'm missing the next Google, but I would avoid that rather than get into that situation, because that investment is not for us.
Actually made a very valid point, because a lot of Indian businesses, particularly, are family run businesses. And in fact, in certain cases, it's the next generation which is coming and, encouraging their, the senior generation to sort of back private equity capital or to take money from private equity or growth stage investors. So, the ability versus intent question really comes in again, because they might not intentionally, like you said in your example, he was trying to justify that it was before IPO, but it was maybe because they are just not used to dealing with investors or anyone. And on an ability basis, on a lighter note, from a lawyer perspective, they don't like going to lawyers, or they like to get the most local lawyer and, like, get the work done. So, how do you have a certain base case like metrics which you're looking at when you're seeing the intent versus ability? Because they might have the ability, or rather they might have the intent, but they might not even have the ability to engage with the right kind of people. So is that somewhere you step in and give them the right vendor contracts, connects and everything?
See, you can templatize, have matrices for ability. For intent, you can never have that, right? One has to be very careful, because each time we come up or we encounter a different issue with each company, it's never the same thing, right? There are some intent. I mean, you can clearly see the person doesn't have the intent to grow the business, right? And they're taking the money. Yes, they're getting in an external investor because probably it's fashionable, or probably he's being told by a merchant banker that before an IPO, it's good to have an institutional investor on your cap table, and they do that. Now, that's, I mean, it's good. It's deal flow for us. Maybe it's a good investment opportunity, but it's better to stay away from those kind of companies than to invest, because there are enough opportunities. There's a dearth of capital in the mid market, right? And so there are a lot of opportunities. Yes, good companies come at a higher value, and we are all programmed not to pay that value. So that's where we come in, right? That's why we have a job cut out for us, and that's the role we need to play. And it's just not filtering. It's not a pre-IPO kind of investment where you can sit at a desk and say, "ठीक है, मैं 100 crore का डाल देता हूँ." We can't do that. In fact, at Stakeboat Capital, we've not had a single IPO exit. All our exits have been either sales to other financial sponsors or to strategics. And that's our preferred exit route even today. That's what we prefer. And I don't know whether we will have any of our companies going IPO in the near future. If they do, good. If they don't, fine. Because, we've kind of taken care of that. If I want to sell a business to another strategic, they will assume that we've already cleaned up all of these things. That's why they're buying it. So there's a huge onus on us. Even a financial sponsor that I might be selling to, they might be building a platform. When they're building a platform, they don't have the bandwidth to focus a lot on a single investment. They focus a lot more on value creation at that stage. If they're doing that, then they probably also assume that, we've done our work. Now, if they're assuming all of that, they, imposing, or rather, they're reposing a lot of faith on us. If they're doing that, we have to live up to it. And that also determines whether I can raise my next fund. So we have to be careful. So there are no templates to intent.
Thank you for that. The next one is to Sumit Jain from 361 Asset. So 361 obviously straddles, you have a large group, you straddle between early stage, venture capital, growth stage, and now you even have a secondaries market fund, right? Now, how does the mid-stage team actually, leverage, or rather the growth stage capital team leverage from the group broader network And does that help you in deal sourcing, deal evaluation, particularly because you might have a venture capital fund invested and you would be giving probably an exit to that fund by coming in at the growth stage? And how do you guys manage then conflicts and LP expectations and making sure that that fund should not have continued in the company whereas another fund comes in?
We've always had secondaries and pre-IPO books. We started out with that, so that's always been part of the platform. I think interesting question. How do we as venture growth, focused investors, how do we leverage from the rest of the group? One of the things, Ananya, that's happened in our view over the last 12, 18 months is that companies are getting to venture growth stage far quicker, right? I'm sure we've all come across consumer companies that have got to 100, 150, 200 crores revenue scale in 12, 18, 24 months of launch. And that was not the case 5 years ago, right? We've come across SaaS type or AI type companies that have got to 20, 30, 40 million dollars of revenue scale within 18 months of launch. Some of you may have heard about our investment in this company called NESA, which is an AI infrastructure platform. This company was started in 2023 by Sharat Sanghi, and this company has an enterprise valuation today of about $1.4 billion. Blackstone invested in them, we invested in them. So this is a phenomenon which has really started in the last, I would say, 2 years. How does that, impact us, or what is our perspective on this? Being the multi-stage platform that we are able to look at, companies from one or the other vehicle, irrespective of their stage or their, check size or valuation, because somebody or the other will find it relevant, right? So we call ourselves a idea to IPO platform, right? And so every private opportunity that exists, there will be somebody at 361 Asset who will find it relevant for their strategy and will engage, right? So that's one. And the second is, especially for venture growth, we are a team of 35, 40 people, and we are probably India's only platform where venture capital and private equity actually sit at the same place and work together, right? So which means that especially for venture growth, whenever an opportunity comes by, there is definitely, some prior interaction that has happened through somebody else on the platform. So we have notes, we have prior history, and if we are able to not engage with the deal at a certain stage, we'll always catch them at the next stage or the next stage or the next stage, right? So to that extent, we feel like we want to straddle the entire sector and stage roadmap. But I just feel like, this collective, experience and network of people sitting together and working is just very powerful from our perspective.
Since you brought up the AI infrastructure question, and we've had differing aspects and opinions on AI, I'll actually open this to the entire panel. How is AI itself as a trend changing your investment? It could be in the form of what Deepak mentioned in terms of AI, whether this company is going to be able to sustain the AI trend. It could be Sumit mentioning that AI services would be more, value creating rather than AI as an infrastructure. You obviously mentioned the AI infrastructure aspect. And I'd actually like to get Srini's views also, because you are dealing with companies probably where they're getting investment for the first time. And how do you juxtapose or evaluate those kind of companies and their businesses with the way have they been able to adapt AI? Does that become an important consideration for you? And how will they adapt to the AI world?
So if I look at our set of companies, for all of them, or for most of them, AI is an opportunity, right? They use AI to maybe save costs for their customers. They use AI to save costs for themselves, right? Now we call it AI today. 30 years ago, 35 years ago, when I studied, we called it expert systems. There's no difference, right? It's just that the technology has become so powerful today. and your ability to deliver has improved. As a consequence, those expert systems have actually become a reality. It's no longer on paper. 27 years ago, 26 years ago, 27 years ago, invested in a company which we called it an expert system today. Today, we would call that AI. In fact, I see a company out there in the market which has got hundreds of millions of dollars, which is solving the same problem that company was solving in 1999. And we invested a princely sum of 1.8 crores, and Carlyle invested a princely sum of 10.8 crores in that company at that time. Okay, now they were solving the same thing, right? So they were taking data and they were building a layer on top which will use data to provide diagnosis. It was in the healthcare domain. Today that will be AI. Now, what is important is how you can use that to automate processes and help your customers, because that will definitely save time. And today, if I'm looking at the manufacturing sector, for example, tech, it's obvious, you can use AI. Healthcare, I've just given you an example in terms of what's happening. All of us know that this is happening. In the life sciences space, they're using AI in the discovery phase today, where there are tools available which will shorten the cycle and probably increase or improve the outcomes. But remember, AI is GIGO, right? It is a function of the data it has been fed. Now, if the data is wrong, the outcome is wrong, right? And it also is a situation of blinkers on. It can only give you a solution based on what, again, you have fed. So when it comes to thinking beyond, I think humans are still probably better. So I don't think humans are going out of the equation as yet, okay? That's my view. And when it comes to manufacturing, our issue is how do we use AI to improve outcomes? For example, we have a company which does robotic automation, okay? So they essentially help industrial companies to use robots on their shop floor. So they would go into a company, they will study the process, and they will figure out how to automate it and use what kind of robots. There are hundreds and hundreds of types of robots available there. So they would take that, but all these robots are just, again, dumb in terms of, the robots don't know what to do unless you write the necessary code, right? And if you see a humanoid kind of a robot, or all of us probably have seen, car manufacturing assembly lines, which have a whole host of robots. And we'll see these arms which are doing welding or sniffing or whatever they're doing, right? So in reality, those robots do not have the end fitment. They have a stub. They'll have a whole host of wires and maybe, pneumatic tubes that'll all be there. So a company like, this company is called De Facto, a company like De Facto will have to actually design the end fitment, use the features of the robot to perform the task. And they have to decide how many robots, optimize based on what output you want, and also the budget, right? So they do all of that. Now, when they do that, there is a huge opportunity to use AI. Now, the AI will not work without automation in manufacturing. So it's interrelated. So there's, we see AI as a solution and opportunity. More importantly, we see AI as an opportunity for ourselves. We are using AI for evaluation, right? We're using AI to generate our documents. I have team members, if I tell them to do some work, they'll come back to me faster than what we used to do, because they're doing it in AI today. I'm sure in your profession as well, there's a lot of use of AI. So AI is an opportunity and all of us should use it. So I don't see that as an issue. And as an investment destination, we'll probably end up investing in AI companies. And I agree with Sumit that, there's a huge opportunity in services. And again, I've always seen SaaS as just a terminology, because we've always been backing enterprise softwares, right? It's not that. It's just that it's changed the pricing model, because earlier we used to call it ASP services 25 years ago. Now it is called, or it was called SaaS. You're putting in AI on top of that. But ultimately, you need to solve a problem for a customer, then they buy. And if you're solving it efficiently, they'll pay for it. And how much they pay for it is dependent on what they're solving, right? And whether there's somebody else doing it or not, it's a question of supply and demand. So I would rather break it down into simple things like this. Is there an opportunity? Are they really solving a problem? And are there others doing it? So how much can I make from it? What is the future for it? Is there a threat to it? Simple things like this, which we use elsewhere. So for evaluating AI, would I use a different framework? Probably not. But will we use AI in our processes and for our portfolio companies? Definitely yes.
Anyone else?
I recently read a very interesting analogy for AI, and that stuck with me for a little bit. You know, if you were to imagine AI as a city, okay, there is the plumbing and the utility works and the power systems. There are the roads and buildings, and then there's the shops and restaurants, right? The shops and restaurants are where the consumer is going to consume whatever is available. The plumbing and the utility is being built by data centers, LLMs. The roads and buildings are built by the hyperscalers, and the restaurants and shops are being built by the applications. Now, some of those could be owned by the plumbing companies or the hyperscalers or young startups. I think the question we are all trying to answer, I guess, is where is India's play in this whole AI stack, and where do we have some right to win, right? Now, there are people who put their stake on the ground saying a NASA can actually do the data center business well, or a Emergent can actually do the large shop of building code or whatever. But I think, you know, the problem we are facing, or the problem we are trying to solve for, is where is India's right to win, and we are trying to find the right answers. I think Sumit's insight earlier was very, very interesting, is to say India's strength in the past has been to offer, you know, the human in the loop type interventions. And I think that might be somewhat of a hidden answer on where, you know, India might win in this whole AI city business model, where not only do you need to have the access to the plumbing and to the roads and buildings, but also you need to provide this human in the loop layer, which is very bespoke to India, and where India's structural advantages can actually give you a little bit of a winning edge.
At the horizontals of AI, I think the model providers themselves will provide it. Services, services that are broad and horizontal, I think agents will take care of it at some point in time. I don't think there will be too many people required for that, at least from a horizontal standpoint. But I think where India can really play a role, according to me, and it is, I think for us, at least for this fund, it is early, but where there is deep domain expertise, right? So for example, pharma is where we've been doing pharma for the last 30 years. Hospitals, healthcare we've been doing for the last whatever. So the kind of volume that we have in some of these, even entertainment, for example. So there are multiple things where we have great domain expertise in. I don't think building on using that domain expertise is going to be very challenging, because the tools will make it so easy, provided that you understand the workflows very well, provided that you understand the domain so well that you will be able to build it. So I think maybe the next layer of Indian innovation is going to come in a domain-specific way. Also, for good or bad, data for us and privacy, we have already given up everything, I think. Our Aadhaar card is probably with maybe 10 people in the room have my Aadhaar card as well. So, so I think they are using data to train the models. I think there is plenty of opportunity in India, because the rules are lax. And whether it is good or bad, I don't know. But there is plenty of data available. I think the model providers are also looking at India for that as well. So I think domain expertise and data, these are the two things that we have. I agree with Sumit and both the Sumits that services will be a play, but I think it has to be more domain specific in my opinion.
So from company's point of view, definitely AI is one of the important tool. I think manufacturing is still evolution should happen actually. Service sector, not a AI using. But as an investment banker, how we are using AI when we are taking this company on board actually, because this is helping a lot to us actually. So we have a proprietary tool which we have developed internally, and then we are doing a lot of pre-due diligence kind of aspect with the AI. So we have a pre-forensic report actually, where we are getting the entire understanding of the company, where they are having the lot of penalties, lot of delays, lot of directors allegations and the cases and everything. So whenever we are onboarding these companies, we are taking that report and we are reaching to these companies founders, their CFO and other people, and discussing with them that are you aware about these things. Many times we have seen 50-60% they are not aware about these areas because a lot of strategic bodies are there is some GST delay, something. So but it is helping us to understand that where the company is actually. That's the one thing. And then another, creating this the financial model and valuation. So we have automated the valuation through AI. Actually, we have done a lot of work on that. So the valuation is helping a lot, where the lot of peer comparison, DCF, and everything is coming. So as an investment banker, we have taken the plunge, and we are trying to build our model where 50-60% of the initial work which we are doing is to be done through AI. So it is helping a lot in terms of the overall efficiency of the system and the costing part also.
Yeah, so we also at Trilegal actually have our own proprietary AI system where we have taken I think, more as a service and got plugins from the various more marketable AIs like Lucio and Lucio is our internal proprietary software, and then we have it customized for Trilegal, and there we use it to primarily, diligence documents or to review documents. Obviously, it's as Srini said, right? It's Gigo. It's like what I'm inputting is what I'm going to get the output. So unless I train it to specifically make it read certain clauses or something, it's not going to really reach. Obviously, from a law perspective, it's far behind. It's not attuned to right now read any kind of regulation, but it does help us in at least coming up with answers maybe slightly or tangentially quicker than how it would, unless I mean a manual humanly not possible to read probably 100-page documents in 1 hour or 2 hours, but that's what AI really helps in doing.
No, but
Bullpens are not
if you
going.
look at it, I mean, Harvey or Elagora are already there.
Yeah,
They're
so
worth
we
billions of
we
dollars.
came sort of.
Yeah.
So we did not take Harvey from a data private from a customization perspective, because what Lucio allows us to do is that it keeps the data on our server. So
But what I'm
that's,
saying is, I think after coding, if you look at it, the next
Yeah.
one that is getting disrupted is legal.
yes.
Claude is already coming for Harvey and Lagora already. These
Yes.
are all multi-billion
So
dollar
Claude,
companies.
we also have a plugin for Claude, and that's what Claude helps in doing. Is like if I set certain things, it'll help draft. Do I feel that Claude's drafting is going to be optimal? That we can just ask Claude to probably draft an SPA and it's going to be efficient? That may not be. So we also look at AI more as an opportunity rather than as a threat. From our perspective.
I think you should not betray every secret sauce, otherwise the fee negotiations will start.
No, we're actually very we're asked this question actually a lot. That do you use AI? Because like what Sumit said, people are like, you're the only if we tell them that no, we're not using AI or something, then people will think that we're actually not ahead with the times. But accountability and responsibility always stays with us, so that can never change.
But it's improving, no doubt, right?
Yeah.
I'll give you an example.
Yeah.
After working in this industry for donkey's years, SEBI believes that I need to take an exam to prove that I'm worthwhile to be in this place. And the course material that they've published is full of mistakes. Even the carry calculations are wrong. Now, whether a private equity professional knows the laws or not, each one of them can calculate carry perfectly. I can tell you that. So, absolutely. So those are wrong there. Anyway, leaving that aside, what I did is when I had to study for it, I took the course material, put it in an AI tool, and asked for a summary. You know what it gave me? It gave me the table of contents.
That's where we come in handy, right? Because we know that if we just tell someone to use, if somebody is going to give us an AI summary, we know that we'll be able to make enough corrections to show our value. Okay. I think moving on from your perspective, Ashish, if you can give us some insight on where you see the biggest gap in India's growth stage capital story.
Already in my initial comment, I have already discussed this part actually. If you see the gap in the India's growth capital, so missing middle, which topic which I have discussed actually. So you see one thing which I have discussed is from the ventures to the banking debt. Actually, this is one area where as companies are struggling. They got the venture funding, and then they are growing actually, and they are struggling for getting the this next round of the equity and all. But they need the senior debt actually. That's the one area which need to be looked upon. And the second area which I already highlighted, that's the pool of capital which is available in the country. So if this PF money or the insurance and banking money will come in the system, this will be a patient capital. Government is trying a lot actually, and I think this PFRDA and all already announced that 1% of the corpus out of 35 lakh crore can go for the PE fund and VC fund. But still, there are challenges in terms of execution or implementation of that. The one big challenge which is there, which I think all these people will be aware, that these PF funds are looking for the daily NAV of the fund actually. And in case of the PE fund and VC fund, there is not a daily NAV concept. Actually, mutual fund and all, we have a daily NAV concept. So this PFRD money is not coming to the system in the PE VC ecosystem because of that actually. So we are also working with the PFRDA trying to solve out that problem. So once this problem will be solved out, regulation is there, but implementation is not happening actually. So this money will also help to get the money for the growth capital and mid market. These are the areas where I think requirement is there. This private performing credit and the private credit is also there. But if you see, there is another challenge also for the company which are in growing stage actually. So always they are struggling to decide whether they should go for IPO or they should go for the private equity or they should go for the private credit actually. So where the gap is there actually, if you see, because somebody told that you are funded to a company which is a founder of 20 years old and all. So these people are always reluctant to go for the private equity because they have some apprehension in their mind. Actually, being investment banker, we are getting these kind of stories on daily basis. Young people, young children have come in the business. They want to do something, the family office or something. They don't want to part of the business also. So actually, the gap is there from not from the funding point of view, from the industry point of view also. There is a need of some kind of awareness and education among these industry which are in the tier 2 and tier 3 towns actually. Tier 1 town, lot of things are happening actually, but there are many companies which are 500, 700, 800, 1000 crore of top line in the tier 2 towns, tier 3 towns. But still they are struggling to decide whether they should go for the private equity or not because of their apprehension in the mind that the fund will come, they'll ask the board seat, they'll ask many other things and all basically. So these are the gaps, not from the fund point of view, from the industry point of view.
Thanks. So, the bid ask spread is basically a defining feature. Now, are deals actually getting done at disciplined valuations or there's a standoff? And where do you see the gap being bridged? Because obviously sellers remember the 2021 era and buyers want to underwrite what's going to happen 2026 and post. So I just open this to all the panelists to, weigh in on how do you bridge the gap.
Yeah, I can go first. Yeah, there's always a bid-ask spread, by the way. By definition, it exists even in the worst of markets. People complain about high valuations, and the best of markets, people do all types of deals. But we are definitely off the peak 2021-22 valuations. We are seeing founders and investors, VC investors, being more reasonable about what they will get in the next round. When there are a few conversations we're having where the round we are leading will practically be zero premium to the 2022 valuation mark that they had. That means that sense of some sensibility has come into the market. I think the secondary piece is a helpful tool to bridge the gap because while the primary may still be pegged at a high valuation, there's a reasonable secondary discount that people are happy to give, and that helps us average down our entry price. But it's never easy. But gone are the days of valuations just so crazy that you don't even pick up the pen. Now at least we're happy to spend the time, do the work, get comfortable, and arrive at a price which is still higher than what you want to pay, but reasonably so.
It's good to have the spread. That actually tells you, because if it was the negative spread, I would be surprised. I mean, I would probably stay away from it because there's something critically wrong there. At least that's what my brain is programmed to think, right? So the spread is good. But one of the things that has happened in the market is the broadening of the market and also deepening. I'll tell you what I mean by broadening. The financing options have improved because we prefer to do control deals. So we need to be able to find a solution. It can't just be our capital. There are other sources of capital which will allow us to bridge the gap. Now, it could be debt. You know, we normally end up investing in companies which are fairly profitable, and rarely do they have debt on their balance sheets when we are going in these days. Probably very different from what we used to see 5-10 years ago. A lot of companies have paid their debt down. So when we go in there, that gives us an ability to probably put some debt, right? And there is debt available in the market. And this debt is coming in at reasonable prices. It's no longer like 18, 21, 25% kind of numbers. People are talking about 11, 12%. And this is unsecured debt. The only thing they may end up taking is my shares. I mean, it can be a last kind of a product. That's big thing. They're not asking for secondary collateral, property, and those kind of stuff. So that helps. The other thing that's also helping is that we have these pre-IPO funds. If you're getting into a situation where the IPO can potentially happen in the next 18 to 24 months, then you can probably access some of those investors. Their return expectations are different from ours, right? The second thing is their only thing they may ask for is preferred liquidity over us. Now, if in a situation we can provide that, happy to look at that because it kind of brings my costs down and improves my ability to pay a price the seller is expecting. Having said, in the last 1 year at least, I've seen a significant decline in expectations in value. What people were expecting 24 months ago, they're not expecting today. So it's become much better to do deals, but it's taking time. Deals are taking much longer, is what I've seen. So I don't know what others have experienced.
I think one of the parameters that's playing into the whole valuation discussion at our stage is the blurring of boundaries between private and listed. You have several precedents now of companies that were highly rated, maybe even overhyped, that have gone listed and been brought down to perhaps the more reasonable levels by analysts through quarterly reporting and everything. And I think that's played back into our space, the private space, to say you can't just keep telling stories because those stories need to be justified at some point. And on the other hand, there's also, some companies which were relatively, how should I say, undervalued at private and in the public market. Some of you may have followed the listing of this company called Kisht, I think a few weeks ago. And that company got, priced at 11 or 12 times of trailing earnings. And, sure enough, the market saw that and, it obviously corrected massively upwards. So, I think that balancing that is being brought about by the public markets into our space has been a huge leveler. And I would agree with, all of your comments that there's far more discipline today in pricing because somewhere there is a precedent in your sector, in your stage, in your kind of, nuance of a company that has been priced very well by a very stable, relatively stable and deep market. So I would say the public-private sort of nexus is playing out in a very healthy way, I would say, in the whole valuation discussion.
The other thing to look at is probably companies who have also run out of money, so they have to raise. So ultimately, they've held out as much as possible, and now they know that the 21 cycle is not coming back, and probably that is, and they're forced to raise because ultimately business is going to suffer if they don't raise, right? And hopefully the venture investors have also realized that those times are gone, and the markets are correcting, and obviously the pools of money that are available for the growth stage are also shrunk a little bit. So I think all of that is playing a part in at least valuations being where they are.
Just to add, it's also a function of who we are competing with, right? I'm not talking about IPO competition because normally we don't see that, at least not right now. If our competition is M&A and then we are competing with a strategic on the other side. And if that strategic is, whether that strategic is European, American, or Indian, the valuations change, right? So that is the biggest issue. And the second one is if we are competing with other funds, I think there's far more discipline in terms of, because all of us know what our target returns are, and therefore we probably played much safer. The only way we can probably differentiate is through what I was talking about earlier in terms of funding sources. That's probably what drives differences in valuations from different funds, I guess.
Just to add more on that, actually, valuation will always be, I think, bid and ask will always be a situation where expectation mismatch will be there. A lot of manufacturing growth is happening in the country. If you see the government which come with the PLI and all, so there are many companies which have reached to certain stage. And just one example, one case study. One of the founder came to us, and they are into manufacturing, earning good EBITDA and all. Their valuation expectation was on the higher side, keeping in mind they said that setting a plant which will generate the revenue of 2 times of whatever they are earning as of today, and the numbers will be drastically different after 2 years. So they said they want to raise private equity, but the valuation asked will completely different actually. So the performing credit helps a lot actually. We could convince them that instead of going direct private equity at this stage, you go for the performing credit, you raise money, you raise debt, banking debt also, and mix of that you achieve that number which you want to achieve after 2 years, so that the private equity funds can consider you from that valuation point. Or it has happened, and they could raise we could raise that performing credit for them, and they have blended it with the debt, and then they have gone for the private equity. So currently the deal is on in the private equity market, and the valuation mismatch is very limited now, very I think thin now actually. So these kind of structures can help because the valuation mismatch will always be there. Although the good thing is that currently the IPO market is not doing very well, so the valuation expectations are low. For the PE funds, this is a good time to invest. Actually, a lot of dry powder is there. People are still waiting, but I believe after 1 year, this market will not be like that. There are a lot of IPO deals will be there in the market actually. Yeah.
Yeah, so on tech companies, we have also been involved in transactions where tech companies, particularly those which raised capital back in like 17, 18 at really crazy valuations, did have to undergo valuation resets and, have to think through structures, particularly they had foreign investments. So from a legal perspective, also had to think through the, new fundraisers and how to manage their existing investments and all. So, how are you looking, all who are investing in tech companies, how are y'all looking at tech company valuation resets? Because now clearly the market is not just driven by growth or like crazy growth, and we'll take a look at profits later, but now people want to see profits as well before they go into an IPO or an exit strategy. So, how do you look at that valuation?
Yeah, tech is a catch-all phrase now. Every business is tech and tech-led. But if you look at different segments, enterprise software obviously has seen a massive correction, thanks to not just the global AI boom, but also because the public markets in India have given them a reality check. It's not 10 times revenue anymore; it's 20, 25 times EBITDA, and that reality check has been a huge eye opener for every private company. And we are seeing the next set of companies being more reasonable in terms of how the valuation will be. But there are certain forms of tech which we look at less, which are a little bit still in the venture space, where valuations are still up in the air. If you're an AI native software today, valuations would be crazy. If you are building something in the deep tech space, let's say aerospace or something in the space tech, valuations would be crazy. So tech by definition always has exuberance built in. And so we kind of stay away from that. But by and large, the broader tech market in enterprise software or tech-led consumer brands, some of those we see valuations are pretty reasonable now.
I'm just conscious of time. So I'll just quickly move on to if there are, I think we've discussed preferred exit modes and everything. I think what's important is that when do you feel in your growth stage investment journeys, do you feel that is the right or the optimum time for a company to start looking at the next level, be it public markets or be it transferring to a strategic or something, and then we'll just open it up for the audience.
The next day that we invest. So what is that's the ideal one where we can get an exit if once the money goes in. But um, seriously, I think depends on how the markets. I mean, the way we look at it is, I think anywhere between a 300 million to 500 million exit valuation opens up multiple avenues. At 300 to 400 million, I think you can do an IPO. The larger PE funds obviously have a lot of dry powder, which can write deals in that. I mean, which can basically buy us out at that kind of valuations. Strategics also, I think once it goes above 500 million, I think strategics will bulk as well. So I think that 300 to 500 million is probably from an exit standpoint a good barometer for multiple exits to open up.
I will add one point on IPO though. I think people are going IPO earlier than they should, because one is to go hit the public market and list yourself. I think that's the easy part. You need to have some scale, some margin potential, or some kind of forecast, and there'll be enough bankers who will push you into the public market. I think the real test is after you list, and that's something we have to be very cognizant of when we ask our portfolio companies to work towards that path, because you need to have you need to build enough predictability in your business so that you can deliver quarter-on-quarter returns. You need to show path to cash flow. EBITDA is just an interim metric, and cash flow is the real metric. And you need to have a cap table which is amenable to a listing. Because if you have too many large shareholders who are eventually looking to list and there's a massive hangover and there's no liquidity, then the price is irrelevant. And so you fall into that trap of having an illiquid asset. I remember at Warburg, we were invested in a company called WNS, and I was part of that deal. Forever, WNS used to trade at a discount to Genpact and EXL, despite similar performance, and used to scratch ahead why. The answer was Warburg used to own 60% of the company after listing. So eventually, Warburg had to bite the bullet and sell half of its holding at that price. And as soon as it sold, the price doubled within 6 months. So Warburg didn't get any upside. So eventually, you have to have the right cap table which finds the liquidity, and we've seen that play out in the market lately.
You know, for us, we start looking at exit even before we invest, and I'm probably saying that for all of us, right? So in terms of, you need to be sure what the possible exit route could be for a particular investment. And we also need to iron out or list out what we need to do to achieve that exit. It's not going to happen the next day, as Deepak said, for sure. But, you know, we need to know what we need to do. Sometimes it could be, revenue growth. That's the easiest thing. It could be margin expansion, what we need to do. Or it could be simple thing like balance sheet correction. That's a much simpler thing to do, believe me. Or it could also do, we may need to do correct their business model. We may need to bridge. We may need to do an M&A or whatever it is. So all of those we need to iron out, and it's a dynamic thing. More importantly, at a fund level, we have to constantly evaluate whether we're giving back money to our LPs, right? Is there an opportunity today whereby I can give back some capital to my LP? Because, you know, every 2-3 years, I need to go back to the LP to raise a new fund. If we've not done the DPI, then it becomes difficult, right? So therefore, money needs to go back. So at any point in time, even if I'm not realizing my full potential, like the example that he gave about WNS, one may need to still exit, right? Give back some money and then go back and raise the next fund. So it's a treadmill.
Yeah, just one rejoinder to Sumit's point on companies going IPO too early. That's always a longer and more philosophical discussion. I've chatted with several public markets people who kind of complain that, you know, in the last 10-15 years, the venture capital private equity ecosystem completely juices out a company's potential, you know, while they're growing at 30, 50, 60%. And by the time these companies list, they're all growing 10, 12, 15%. So there's nothing left for the retail investor to make money out of. I think that has changed. And there is a section of demand in the public market that wants those companies that are growing at 40, 50, 60, 70% They may or may not be profitable or may or may not be immediately profitable, and therefore those companies will land up, and go public because there's some demand. What we though guide our companies is that billion-dollar revenue or 100 million customers, all of those metrics are great, but maybe they are somewhat vanity. We guide our companies to a 100 to 250 crore type of profit, right? At which scale we think a very nice listing is possible in India, and that is sort of coming across as the holy grail for most of our companies to chase that rather than vanity metrics of top line and many of those sorts of things.
Okay, we'll just open it up for the audience. Please do state your name and to whom the question is also once you're asking the question.
Thank you, Ananya, for the very interesting session. My name is Bharti, and my question is to all of you. So we are living in so much of uncertainty, right? Geopolitical uncertainty, rupee volatility, and so much. Has that changed your investment thesis in any way? Because we have been at it for like 4 years. 2 wars are going on. So, in what way has made in India become important, or maybe there are some other sectors you started looking at which you were previously not looking at?
I can take a quick crack at it. One of the new themes that have emerged for us arising out of geopolitical uncertainty and the territorial geopolitics that we are seeing is China plus one type strategy. So there are lots of businesses where we are now comfortable taking a call that global customers are going to be looking for options outside of the manufacturing mecca that China has always been. And I have several live examples from our portfolio of why a specific company, especially in the manufacturing and more deep tech and hardware type spaces, why certain companies in India today have a right to win, which would have been very difficult to put your finger on maybe 10 years ago, because you would say, how would you ever compete with those behemoths in China? So that's one thing that's come out. The other one is exchange rates, and this is a constant question that I think we don't have a very comfortable answer to today, right? Why trying to deliver dollar returns on our asset class has become increasingly harder over the last few years, and I don't know if you'll answer the question soon enough. But those are two very immediate fallouts that have come out of what's happened in the world in the last, I would say, 18 months.
I would just say that uncertainty has always been a constant. It's nothing new. We've always had some or the other situation in India, very rare, or global trends. Something or the other has always had an overweight on India. So from that point of view, we have to be smarter as fund managers, right? Once we made an investment, if there is some issue that comes up, we have to find a solution, because we can't give up. We can't let an investment die. So we have to find a way to make them work. And that's what we do. And that's why we earn our fees. And we have to do that. So, right. And will that have an impact on the investment strategy for the next fund? Probably yes. But once we've raised a fund with a particular investment strategy, we are kind of constrained by the strategy for that fund. You can't really do much, right? So what we tend to probably do is work on the portfolio and maybe use those macro trends at the portfolio level.
You rightly told, geopolitical situation has created an energy crisis across the world actually. So if you see as an investment bank, we have also identified that opportunities, the company which are into energy transition actually, which are very, very important, and their growth is also happening. Government is also supporting a lot actually. So this is an area where I think a lot of traction is also happening. And as an investment bank, we are focusing as a fund. We have seen a lot of climate funds are coming, which are looking such kind of companies actually.
Yeah, I mean, I can tell you one segment we look at is the new age consumer brand segment, and there the raw material costs are going up like never before. And this is a good test of time when some brands will be able to pass on those costs to the customers and some will not. And we think of that a lot about companies we look at, and will be a pretty defining year for them, because the boys will get separated from men.
Hi, I have a question. Thank you so much for the insights and lovely session. I'm Megha from Akia Connect, and my question is around exits to the panel as a whole. since the notion is around that exits are the most important metric out there. So what are the characteristics of the companies that really distinguish them from the companies that have successfully taken an exit and the companies that are say trapped in the portfolio for say 10 plus years or 8 plus years today?
I can start there. It's a simple answer actually. If a company is large enough, profitable, and growing predictably, if you can tick all these boxes, then exit will come on its own. People will actually come knock on your door and ask for the shares. The problem happens when the company either stops growing, doesn't build enough scale, is not profitable, and it's not able to show a line of sight to sustainability. Then exit's gonna be tough. So our job actually is to find the right companies and grow them the right way, and the exit should follow.
Liquidity is one of the important rules in fund management. So we need, when we're managing a portfolio, you have to take your calls. You may want to leave something on the table, you'll always get an exit. So it really depends on what we want to do. We're not looking at only an IPO exit. If you're looking at an IPO exit, yes, there are thresholds that you need to meet for an IPO, right? Unless 300, 400 million, that's what people are talking about today as the market cap for a company to get listed, without which you don't have institutional interest. And if there's no institutional interest and we have a huge stake, you can't sell. And off of a sale is always a defensive exit because you don't get the value that you would want to get. So as a consequence, there's no single way of doing this. It's just dynamic.
One of the, I think, interesting phenomena that has happened to these companies trapped in portfolios for 8, 10, 12 years is IPO roll-ups. These are companies that can't go to an IPO themselves. They are finding for IPO candidates who want to bulk up, right? Several examples of those, and that has become some sort of a exit path also. Just IPO roll-ups, look for candidates that are trying to bulk up.
My name is Garima. My question is to Sumit sir from 361. So you had earlier said that you were at that unique space where you were both in the PE and the VC space. So being at that unique juncture, and Deepak sir had also said at the start of the conversation, how with which lens do you view growth stage capital? Like, what are the criteria which distinguishes an early stage company from a growth stage company? Is it profitability? Is it stage? Is it revenue? What does the company have to show for you to distinguish between growth stage and early stage?
I'm glad you asked that. And by the way, I'm going to take off my 361 asset hat and wear my venture growth hat, right? There is, I think, various ways in which people define product market fit. If you ask a seed stage investor, he might say getting 1 million downloads of my app is product market fit. Some might say that 2% paid customers, or some might say a month 12 retention might be a product market fit, right? So that definition is different for everybody. For our fund at Venture Growth, product market fit is when you have a product that people want to pay for, and they'll pay enough so that you can, as a business, retain margins, and that you can find those customers without breaking your bank, right? So there's various things addressed there, right? You can make a margin, people need it, and you can find that customer without killing yourself on CAC, right? When businesses show those characteristics is when they become relevant to our venture growth fund. Just to leave you with some tangible numbers, if we are looking for a consumer company, the scale that we are looking for is usually between 10 to 20, 25 crores of revenue per month, right? And we are sticklers for the company creating CM2 level positive economics, which means that every transaction you do, you've made some money, even after taking into account what CAC you spent on that transaction, right? So CM2. For technology companies, SaaS, and I know it's becoming increasingly irrelevant now, but for what it's worth, our revenue benchmarks and thresholds are somewhat lower. So a $5 to $8 million of recurring revenue run rate is good enough for us to want to look at a SaaS technology type company, which we would consider at a venture growth stage.
Yeah, I mean, it's every firm will have a different definition. I think we we look for a little bit more maturity, not just from a size perspective, but also from a unit economics standpoint. And we also look at mortality risk or the lack of. We cannot underwrite a deal where it may do great, but it may just not be around 10 years later. So I think that when the risk reward is balanced towards, downside protection, but still a decent upside, is what we call, beginning of tech growth equity or venture growth, where you put it.
Okay, that's all we have time for. Thank you for to all the panelists. But before we part, I just have one quick fire question. What is one sector, one business model that you guys are looking to put your money on this year, 26, 27?
I don't think there is anything specific. I think it's more bottoms up, to be honest. It depends on in India, founder is the most important aspect, in my opinion. Any super founder, I think, is somebody with good metrics in terms of the stage of the company, I think, is what we would look. I would not say that it's specific.
Manufacturing in India for the world, whatever that is.
I would say the next generation of brands, because for decades we've been consuming really low quality products sold by large oligopolies in India because of the distribution muscle. But now with quick commerce and online commerce, the better quality products are actually getting light of the day. And this is a massive revolution in my view.
I think one of the answers has to include something AI, so I'm going to give that answer. I haven't found the perfect company yet, but a cybersecurity company broadly addressing, new generation of threats for enterprises and consumers through agentic AI and quantum is what would be an interesting investment theme over the next 1 or 2 years.
I told energy transition is one of the area where battery storage is one of the major thing actually, which is upcoming a lot actually. And government is also focused.
Okay. Thank you, everyone.
Thanks, all of you. This was a very well conducted session. It sets up the stage for the session post lunch sector focus panel. We'll break for lunch and rejoin at 2:30. Thank you.